Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. On a monthly basis, I produce um, a deck, a slide deck, along with the corresponding video that discusses a number of economic or market concepts that may not be covered by your current advisor and or the media. So, as some of you know who've seen the videos in the past, I like to start out with some headlines. The U.S. economy is cooling, and we're seeing that both in equity markets and in housing. But the labor market continues to be strong, and that's important as the Fed looks to understand where the terminal rate should be with interest rate hikes. Large majorities of CEOs predict recession in 2023. It's kind of a self-fulfilling prophecy. If they think it's coming, then they will manage towards it and create it. And then finally, I thought it was interesting that individual investors continue to hang on to stocks while hedge funds, institutional investors have reduced their equity allocations. The global business cycle is heading towards a slowdown. Central banks around the world are increasing interest rates, just like the US, to bring down inflation and slow the speed of the economy. But clearly, we are headed towards a slowdown or a recession across the globe. Two inflation data points that I wanted to visit on that have changed dramatically. If you recall, over the summer period, we had lumber prices shoot through the roof, and now we've seen them come back down. And that's predominantly housing related, but also supply chain related. Containers, which were astronomically high, again, at the end of last year and the beginning of this year, have come down to a normalized pre-COVID average. As I mentioned before, um, wage growth is an important consideration into the decline of inflation. And so the labor market has yet to show really big effects of the interest rate increases that started back in March. Service jobs are difficult to fill, and so employers are having to pay more, not only to recruit the workers, but to keep the workers. And again, as the interest rates changes by the Fed come into play, we will see a loosening of the employment market, and hopefully see that wage growth begin to decline. The concern, of course, is that the labor market does not show a full and important enough of an impact that the Fed has to continue to raise rates to break the back of labor, if you will. So, question I get a lot: where did American workers go? Well, on the left-hand side is a chart that talks about some secular influences and factors, but two that I want to point out. In the upper right-hand corner, um, this is the number of net migrations into the US. And two things happened that really, really dramatically decreased the number of people coming into the US. One, we had COVID, so there was that restriction. But then number two, President Trump put in some policies that reduced immigration. So that has hurt our economy today. And then finally, we had some 3.5 million Americans retire over the past couple of years for a variety of reasons. And so, just like in the US, in Japan, and in other countries, we are seeing that baby boom generation, as they go to retire, there are not enough younger workers to replace them. And so, we're going to have this tightness or this shortage of workers. Is a deep recession coming in 2023? BlackRock did an interesting white paper. Their calculations put that GDP needs to decline by 2% between now and a year from now in order to impact inflation enough to bring it down to the Fed's target of around 2% on average. So again, we want to focus on all viewpoints and be prepared that if we do see a severe recession, that the portfolios are um, are constructed to benefit the most from these economic activities. This is a great chart by JP Morgan, and it helps us understand from a valuation and size perspective what areas have done well and what haven't. And so we recognize that growth through 2022 has had a difficult year. Value not so good as well, but certainly value better than growth. As we look at current valuations and understand where they are relative to long-term averages, when we look at this red boxed area, we can see that despite the decline in growth, on average, let's call it 30%, we still see higher valuations for growth than we do value, even though value has performed better. We anticipate this trend to continue through next year, through the slowdown or recession, and potentially shifting gears as we come out in potentially the end of 2023 or more likely 2024 from some sort of slowdown or recession. Again, another valuation measure. I think the point of this chart is to recognize that if our 25-year average on the S&P price to earnings is 16.8, and as of September, it was at 15, and I know it has bounced higher since then given the run in the market. Um, um, should we be at a lower PE given all of the tightening by the Federal Reserve? I posit that we should be, and that we will continue to see a decline in equities through the first quarter of next year to right-size valuations, given, again, the impact of the changes in interest rates. This is a chart that I created out of Y charts, and it shows year-to-date the S&P total returns. The green line is just a trend line showing where the market peaked over the 3 previous bear market increases. And what you'll see is that we are significantly and obviously in a downtrend, and we are getting lower highs and lower lows. Do not anticipate this trend changing. We don't have a catalyst for that to occur. And given the change in interest rates since March, don't anticipate any sort of growth bubble that's going to all of a sudden magically appear as our economy heads into a slowdown or recession. Quick, simple chart showing the differentiation between value and growth since the first of the year. And again, continue to believe that this trend will continue. And portfolios are allocated to take advantage of this dislocation. This might be the most important chart of the deck for this month. This comes from Top Down Charts, and it's a combination of surveyed sentiment across equity investors, which is the blue line. So you can see sentiment is low. In fact, it has been as low as it was at the beginning of the pandemic. And so we have equity investors saying, I'm worried, I'm scared, we're going to have a recession, equities are going to go down, yet they have not changed their equity allocation. And as we go back to the first slide with the headlines, that individual investors are continuing to keep their equity allocations constant. The question remains, when will this decline to match expectations? Because again, these expectations are only going to get worse as additional news comes out regarding layoffs. Finally, Pacific Northwest Advisory manages investor money using a sector rotation strategy. This is a chart from NASDAQ Dorsey Wright that just shows the impact of the opportunity of sector rotation and what can happen if you follow sector rotation to its full impact, and what the results were from 92 to 2020. Hope you've enjoyed this review. And if you have any questions, please let me know, and happy holidays. Thank you.